This video will cover the yield curve and the term structure of interest rates. The term structure of interest rates examines the relationship between short-term interest rates and long-term interest rates. Then we'll cover expected future interest rates, also known as forward rates, using the pure expectations hypothesis. So ultimately in this video, what we want to do is gain some intuition as to what the yield curve represents and how to interpret it. Give it some economic meaning. So what I want to do here is start out with what we call a normal yield curve, an upward sloping yield curve. And as you can see, this is the yield curve for Treasury interest rates. And I'll explain why Treasury rates. But let's look at the x-axis here. It says borrowing periods are in years. It's really the maturity of a bond. And the y-axis is the interest rate. Now I picked this yield curve because it represents the yield curve shape that we've seen the most in the last couple of decades. And what I mean by that is, look, you see a steep upward slope early on here. And as you get further out into maturities, the yield flattens out. So let's look at this a little more closely. Right here, you've got 1 month treasuries, like T-bills. Then you have 3-month Treasury bills. You go a little further, 6 month, and then you got 1 year, and then you got 5-year, 10-year, all the way up to 30-year Treasury bonds. And the y-axis has the interest rate, the yield. And so this is an upward sloping yield curve that flattens out. As I said, it's often referred to as a normal yield curve, which is an upward sloping yield curve. You could have a yield curve that's literally flat, say at 3% constant, or starts out around 4% and drops down. Those other types of yield curve shapes are not that common, and they're often related to economic turmoil. So when you see the economy going into a recession, you might see what's called an inverted yield curve, which I referred to as a second ago. It starts out maybe at 4% and drops down, or it could go flat. And so, like I said, the shape of the yield curve is often driven by economic circumstances. And so this yield curve applies to many situations in the U.S. economy over the last several decades. Now, the height of the yield curve is a different story. That changes frequently. So we have a height that starts at, looks like about 1.75% at the 1 month maturity mark, and then goes all the way up to about, close to 3.1 maybe, 3.1% for 30-year securities. That height may go up significantly, especially if we're in a high inflation environment, because you have a high inflation premium IP, and it may be quite low if you have a low inflation premium. And by the way, like we saw in a previous video, since we're dealing with Treasury yields, we don't have liquidity premiums and we don't have default risk premiums. So it simplifies things a bit. And not only does it simplify things, but it also helps with comparability. Because here we're just looking at Treasury securities, and the fact that we don't have any default risk premiums or liquidity premiums simplifies and makes the comparison so much easier. Corporate bonds, on the other hand, tend to have liquidity premiums and default risk premiums, and they vary depending on the company. So it's kind of hard to look at a yield curve for corporate bonds. There are some, by the way. So most often when you hear about a yield curve, it's the Treasury yield curve. And if there's no other descriptor describing the yield curve, it's a Treasury yield curve. So let's move on to a problem that I have outlined on a slide. Here is the problem. We have 1-year interest rates that are 2%. That means starting from now and ending in 1 year, maturing in 1 year, the interest rate is 2%. And then 2-year rates, which are interest rates that start today and go out 2 years to maturity, are 3%. 3-year rates are 3.25%, and 4-year rates are 3.75%. And the questions I have here are, what is the 1-year rate 1 year from now? And what is the 1-year rate 2 years from now? And what is the 2-year rate 2 years from now? Now, I can tell you through lots of experience that if you don't draw this out on a timeline, it becomes very hard to visualize. So my suggestion is put it on a timeline, and then you can see the problem, and it becomes much more manageable. So let me move over to pencil and paper, draw out a timeline, and do some calculations, because what these questions are asking is what are the future expected interest rates, or in other words, what are the forward rates associated with this term structure. So here I've rewritten the information for the term structure, and this is term structure information because what it does is it relates short-term bond rates here to longer-term bond rates. And so the first thing we want to do when we get information like this is graph it, because it's hard, without a visualization, it's hard to wrap your head around it. So start off at time 0, period 1, 2, 3, 4. And what we have here is we have, see this 1 year interest rate? That starts right here and covers 1 year. It's a 1 year interest rate, and these interest rates all start at time 0. It's not told here, but that's what's given. Sometimes these are called spot rates, these 4 interest rates, because they start right here on the spot time 0. And so this interest rate is 2% for that period. And then if we invest in a 2-year bond, we would earn 3% on average each year for 2 years. 3% here. And if we invested in a 3-year bond, we'd earn 3.25% each year on average for 3 years. If we invested in a 4-year bond, it'll be 3 3/4% on average for each of 4 years. Okay, so those are spot rates. They all start right here, time 0. Now, the question that was posed on the slide was, what is the interest rate that starts 1 year from now? So here is now. This is 1 year from now and covers 1 year. In other words, what is this interest rate right here? Call that X. That's the first thing we want to calculate because that was the first question. Sometimes this is called, X here is called a forward rate. It starts in the future in a forward position, so to speak. And it's also known as the expected future interest rates because we're sitting right here at time 0. We know what the interest rate is for 1 year. We know what the interest rate on average is for 2 years, but we don't know what the interest rate will be 1 year from now for a 1 year security. So imagine we're sitting right here. Now imagine yourself going through time. 1 year from now, you sit here and you ask, I wonder what interest rates will be for the next year. That's what this is covering. That's what X will be. And the math to do that is not too bad. What we're going to do is we're going to set up what's sometimes called a no arbitrage condition. And what that means is it's a fancy word for saying, look, we're going to set up a position to be able to back into X, a logical position. So here's how it works. We're going to take $1 and we're going to invest it at 3% for 2 years. So you take 1 plus the interest rate in decimal form, 1 plus the interest rate in decimal form, and compound it 2 periods. That has to equal this dollar amount here. This will be a dollar amount. It'll be like $1.06. I'll show you in a second. This $1.06 should equal what's on the right-hand side. And what's on the right-hand side is, look, we're going to be indifferent. In other words, it'll be equal. The payoff will be equal if we invest for 2 years at 3% on average, or if we invest for 1 year at 2% into a bond. And then when the bond matures at this point, we roll it over into a bond that goes another year. So we take $1 and we know it's going to earn 2% right here. So 1 plus that 2% in decimal form times 1 plus X, right? And that's that interest rate right here. And we're going to put this to the 1 power, and we're going to put this to the 1 power. So the exponents always have to add up. Okay, so this is an exponent of 2, which means it's 2 years. Here we have an interest rate for 1 year. Here we have an interest rate for 1 year. Okay, it all adds up. Okay, now what this says is, look, we're going to be indifferent between the value of this investment and this investment, assuming we back into this X, this interest rate. So when we calculate this interest rate, it's going to be, and by the way, before we go any further, multiplying by 1 doesn't do anything. So get rid of it. It looks messy. Not only that, but these exponents, taking anything to the exponent 1 doesn't do anything either. So just ignore it. So we have 1.03 squared. Or we're just going to divide both sides by 1.02, and that's going to equal 1 plus X. And when we solve for this, we're going to get 1.0400 0.0098 equals 1 plus x. So x is a little over 4%. This equals 4.0098. Okay, so it turns out this guy right here, by the way, is 10609. And so what I'm saying here on this left-hand side is that if you invest $1 at 3% for 2 periods, 2 years, it's going to compound out to be $1.06, a little more than $1.06. And this side will be $1.06, provided you get this little bit more than 4% interest rate right here. Okay? So that's how it works. That's what we mean by no arbitrage condition. In other words, what I'm saying is you don't have to know that term. It just means that, look, we're going to be indifferent between this investment and this investment. So there's no way you can try to shift things around to try to make a profit, because no matter what you do, if you invest in a 2-year security, you're going to earn the same amount of return after 2 years as though when you invest 1 year and then roll it over at this 4%. So there's no way to try to make a profit out of this beyond what's built into these interest rates. The market won't let you. So you're indifferent between the two types of investments, 2 years or 1 year and then rolling over another year. Okay, so that's not so bad. So now the question becomes, and you remind yourself that, go back and look at the slide that we had earlier. The second question on the slide said, look, what's the interest rate that starts 2 years from now? Okay, here's now, this is 2 years from now. That goes out 1 year. What is this interest rate right here? Let's call it X again. Okay, that interest rate, we're going to derive it in the same fashion. We're going to look at a no arbitrage situation, meaning there's no profits to be had between investing in a 3-year security, where we on average earn 3.25% per year. We're going to be indifferent between this and investing 1 year at 2% and then rolling it over in a little more than 4% and then rolling it over to this interest rate. Or said another way, we're indifferent between investing for 3 years at 3.25% per year on average and earning 3% each year for 2 years and then rolling it over into this X%. So let's do the math. We could multiply this out by $1, and I'll show you so you can visualize it. But again, multiplying by 1 doesn't do anything. And so we get $1 invested, and it's going to earn 3.25% for 3 years. So this will come out to like $1.10 or so, just ballpark. $1.10 is what you're going to get. And so that's what you're going to get from this investment right here. Now, we ought to get $1.10 from investing it at 2%, then 4%, and this X%. That's what we want to solve for. So we're going to take $1, it's going to earn 2%, then it's going to earn the 4%, a little more than 4%, and then we're going to multiply this out by 1 plus X to the 1 power. There's a 1 power here, there's a 1 power here, and I kind of messed it up here. This should be $1.0 right here. Okay, and then multiply it by 1.02 to the 1 and so on. Now look, my exponents add up to 3. There's a 3 right there. We're in good shape. Got $1 here and $1 here. Cross it out, cross it out. The ones exponents, ignore them. And so if we take this to the 3rd power, we will get $1.10. About $1.10 is what we're going to get. You could put a dollar sign there if you like, versus what we're going to get here. Now we're going to get 1.02 times 1.040098 times 1 plus X to the 1. Now let's divide both sides by these two numbers. In other words, bring those two numbers and divide. So we're going to divide this $1.10 by 1.02 times 1.040098. And we're going to divide both sides, so that'll cancel out. So when we divide this, we get 1.037518 equals 1 plus X. So that interest rate is a little more than 3.75%. So this is 3.7518 a little more than 3.75%. Now, keep in mind when we do this math, we're compounding things out geometrically, and sometimes it confuses people. And so the math isn't that bad. This is total finance, because finance money compounds over time. But you can always check yourself really easily, because as I said, this is 3% that you earn on average for each of these years. So how do you get a 3% average when you have 2% here? 2 plus what divided by 2 gives you a 3% average? Well, 2 and 4 is 6 divided by 2 gives you 3%. Ballpark. So there you have it. You can just eyeball it without a calculator and come up and say, look, this has to be about 4%. And the same thing happens here. You're going to get 3.25% on average for 3 years. Well, 2 of those, you're going to get 3%. Then what are you going to get in this 1 year in order to get the average up to 3.25%? Take this and weight it by 2/3 and this by 1/3. So the weights add up to 1, and it'll on average come out to be 3.25%. Or take 2 plus the 4 plus the 375, divide it by 3, and you'll get this number. Okay, now the next question is, and let me get a different color here. The next question that's on the slide says, what is the interest rate that starts 2 years from now and covers 2 years? What is this interest rate? We already know that the interest rate for this part is a little over 3.75%. But what is this interest rate here? What is this whole interest rate is really what we want to know. And if we learn this whole interest rate, we get back into this. But the question is asking simply, what is the interest rate that starts 2 years from now and covers 2 years? Okay, my timeline was getting a little messy. So here I cleaned it up a bit. And again, we're trying to solve for this part right here. The interest rate that starts 2 years from now and goes 2 years. Well, we can do it in a slightly different fashion than what we did before. Again, we're going to take this 3.75%. We're going to compound it 4 years because it covers 4 years. And we're going to say that that's indifferent to investing in 3% for 2 years right here, right? So 2 years, 3%, times 1 plus x squared. So notice my exponents add up to 4. So they're equal on both sides. We've accounted for all the time periods. And now we solve for this. And so all we do is we divide both sides by 1.03 squared. And this comes out to be 1.09214 equals 1 plus x squared. Now, take the square root of both sides. If you take the square root of both sides, this guy disappears as 2. Even the brackets kind of disappear. And you take the square root of this, and you get 1.04505 equals 1 plus x. And there you have it. X equals 0.04505. So this interest rate here, put it in purple because that's, if you can't see that, that's actually in purple. This interest rate is 4.505%. And there you have it. So now it's pretty easy to be able to say, look, 1.04505 squared equals 1.037518 to the 1 power times 1 plus x to the 1 power, and we end up solving for this interest rate right here. I'll do it for you really quickly. 1.04505 squared equals, so we're indifferent between investing here or investing here and then rolling it over to this new interest rate, x. And that'll be and we solve for x, we get x equals 0.052637, and so this is 5.2637. We solved the whole thing, but I did it just slightly differently this time by working it out by just having everything on a squared basis here, because we were dealing with two-year periods, and got down to the same math. So you could check this. You can take this, compound it out 4 periods, right? So 1.0375 compounded out, and it'll equal an investment at 2%, then rolling it over into an investment a little over 4%, then an investment that's about 3.75%, and then rolling it over finally to an investment of about 5.26%. It's the same as 3.75% for 4 years. So there you have it, term structure. Now, one more thing. You know, I put this kind of on a flat graph. Why don't we actually make it look like a yield curve? Let me show you. Here I've drawn the yield curve and the short expected future interest rates. So the blue line, if you can see here, this is the yield curve. This is 2%, 3%, 3.25%, and then 3.75%. And then here's the short rates we computed and backed out of this yield curve. And what you can see is, look, these are short-term rates. These rates here on the yield curve are an average of these rates. So this rate here, 2%, is an average just of 2%. This interest rate here, 3%, is an average of these 2 rates. This interest rate here is an average of these 3 short rates. And this 4-year spot rate is an average of these 4 short-term interest rates. So what do you see from this graph? Well, there's a story. The story is short-term interest rates are going to go up. They're starting at 2%, bouncing around 4%, and then going all the way up to 5% plus as time goes on. And keep in mind, we estimated those expected future short rates under the pure expectations hypothesis, or theory, where we assumed that investors were indifferent between various bond maturities. That was key in order for us to be able to back out those expected future short rates. What we'll learn later on in the next chapter when we cover bond valuation is, you know, when interest rates are expected to go up, you probably want to shy away from bonds because you're going to have a loss, a capital loss in bonds, because when interest rates go up, bond prices tend to decline. And so that's the subject of the next chapter.